56% of Americans can't cover a $1,000 emergency. The Federal Reserve confirmed that. Not a guess, a fact. Most people are one flat tire away from financial disaster. But there's a number that changes everything. $20,000. $20,000 is where the entire game shifts forever. Before $20K, you're surviving. After it, you're building. This isn't motivation, this is math. Pure compound math. The median American savings account holds just $400. $400. That's not a safety net. That's nothing. 78% of workers live paycheck to paycheck. That includes people earning six figures. Income isn't the problem. The system isn't designed for you to save money. Every ad, every subscription, every upgrade is designed to drain you. But you can beat it, and 20,000 is the proof. Here's why that specific number matters so much financially. First, 20K covers 6 months of expenses for most people. BLS says median monthly expenses are about $3,800. 6 months of that is roughly $22,800. 20K gets you close. That's real financial breathing room. Second, compound interest actually starts to feel real at 20K. At 10% returns, 20K earns $2,000 a year. $2,000 working for you while you sleep. At $1,000 saved, that's only $100 a year. The difference is massive. That's the power of scale. Money grows money. That's the secret the wealthy understand deeply. Third, 20K unlocks better investment options immediately. Some funds require minimum investments of $3,000 to $10,000. With 20K, you can diversify across multiple asset classes. Diversification reduces risk. Vanguard research proves this consistently. 20,000 is the launch pad. Everything before it is runway. So, how do you actually get to $20,000? Let's break it down into a real, actionable system. Step 1. Know exactly where every dollar goes each month. Track every expense for 30 days. No exceptions. Every cent. Most people have no idea where 30% of income goes. Subscriptions, impulse buys, convenience fees, they add up silently. The average American spends $219 monthly on subscriptions. That's over $2,600 a year on things you forget. Cut half of those. Redirect that money into savings immediately. Small leaks sink big ships. Plug the leaks first. Step 2. Automate your savings on every single payday. Pay yourself first, before rent, before groceries, before everything. Fidelity says automatic savers accumulate 47% more wealth. Remove willpower from the equation. Make it automatic and invisible. $500 a month gets you to 20K in 40 months. 40 months. That's 3 years and 4 months to change your entire financial life forever. Can't do 500? Start with 200. Start with 100. Just start somewhere today. At $200 a month, you hit 20K in 8 years and 4 months. Still worth it. The point is consistency, not the amount. Consistency beats intensity every single time in finance. Step 3. Open a high-yield savings account. Your regular bank pays you almost nothing in interest. Most big banks offer 0.01%. That's literally pennies on thousands of dollars saved. High-yield accounts currently offer 4 to 5%. On 20K, that's $800 a year. Free money for doing nothing different. Just moving your savings to a better account. That's simple. Step 4. Attack high-interest debt before investing. Credit card debt averages 22% interest right now. You can't out-invest 22% interest. Paying off debt is your best guaranteed return on investment. Federal Reserve data shows total U.S. credit card debt hit $1.14 trillion in 25. Average credit card balance per person is over $6,000. That costs over $1,300 yearly. Kill the debt first. Then, every dollar you save actually stays yours and grows for you. Step 5. Increase your income. Saving alone has a ceiling. Earning more has no limit at all. BLS data shows median household income is about $59,000. but the top 20% earn over 100. Side hustles, freelancing, overtime, skill upgrades, every extra dollar accelerates your timeline to 20K dramatically. An extra $500 a month from a side hustle cuts your timeline in half. Do the math. Now let's talk about what happens after you hit 20,000. This is where it gets exciting. Your emergency fund is fully funded. You stop living in financial fear. Stress drops dramatically overnight. You can now take calculated risks, negotiate harder at work, walk away from bad deals confidently. Money in the bank gives you options. Options give you power. Power gives you freedom to choose. Now you split your money. Emergency fund stays in high-yield savings. The rest goes into investments. Open a Roth IRA. The IRS allows $7,000 per year if you're under 50 years old. Roth IRA grows tax-free. You pay taxes now, but never again on gains. That's incredibly powerful. Max out your Roth IRA first. Then open a taxable brokerage account for additional investing beyond that. What should you invest in? Keep it simple. Low-cost index funds beat most active managers consistently. Morningstar data shows over 90% of active funds underperform the S&P 500 over 15 years. VO tracks the S&P 500. Expense ratio of 0.03% historically returns about 10%. VTI gives you the total U.S. stock market, over 4,000 stocks in one single fund purchase. VXUS covers international stocks. Adding global exposure reduces your risk if the U.S. market underperforms temporarily. BND adds bonds for stability. A small allocation smooths out the ride during volatile market downturns significantly. A simple 3-fund portfolio: VTI, VXUS, BND. That's all you need to build serious, long-term wealth. SCHD is another great option. It focuses on dividend-paying stocks with a strong track record of growth. SCHD yields around 3.5% in dividends. Reinvest those dividends and watch compounding accelerate dramatically. Dividends are like planting seeds that grow into trees that drop more seeds every single quarter automatically. QQQ tracks the NASDAQ 100, heavy on tech, higher growth potential but also higher volatility to manage. Don't put everything in QQQ. Use it as a growth satellite around your core VTI or VU position. Dollar cost averaging is your best friend. Invest the same amount every month regardless of market conditions. Vanguard research shows dollar cost averaging reduces timing risk and emotional decision-making over long investment horizons significantly. Time in the market beats timing the market. Every single study confirms this truth without exception. If you miss the 10 best days in the S&P 500 over 20 years, your returns drop by half. That's why you never panic sell. Stay invested. Ride the dips. History always rewards patience and discipline. Let's talk about the stealth wealth mindset. This is what separates real wealth builders from pretenders. The average new car payment in America is $734 a month. That's insane spending. $734 a month invested in VOO for 30 years becomes over $1.4 million instead. Drive a reliable used car. Invest the difference. Your future self will thank you 1,000,000 times. The millionaire next door drives a Toyota. Not a BMW, not a Mercedes, a Toyota. Real data. Stealth wealth means looking average while building extraordinary wealth behind the scenes. Nobody needs to know your balance. Cook at home. The average American household spends over $3,500 a year eating out. Cut that in half. Redirect $1,750 a year into investments. In 20 years, that's over $100K. Housing is your biggest expense. Keep it under 30% of take-home pay. That's the golden rule. Get a roommate. Move to a cheaper area. Negotiate your rent. Every 100 saved monthly compounds into thousands. Now, let's talk about the psychology of money. This is where most people fail even with good income. Lifestyle inflation is the silent killer. Every raise gets absorbed by upgraded spending habits almost immediately. When you get a raise, save at least 50% of the increase. Live on the rest comfortably. The hedonic treadmill is real. More stuff never makes you happier. Studies from Princeton confirm this repeatedly. Happiness plateaus around $75,000 in income according to research. Beyond that, more money adds diminishing returns. So stop chasing things. Chase freedom. Financial freedom is the ultimate luxury that money can actually buy. Let's map out the full journey from 0 to 20K and beyond with real numbers and timelines. Month 1 through 6. Build a $1,000 starter emergency fund. Cut expenses aggressively. Track every dollar spent. Month 7 through 18. Pay off all high-interest debt. Increase income with a side hustle or overtime. Month 19 through 40. Save aggressively toward 20K. Automate 500 or more per month consistently. Month 41 and beyond. Start investing. Open Roth IRA. Buy VTI and VOO. Let compounding do the work. This entire system works on any income. It's about percentages and discipline, not about earning a huge salary. 20,000 is the bridge between surviving and thriving. Cross it and the view changes completely forever. Let's get into the deep numbers now. 20,000 invested in VOO at its historical 10.26% average return. After 10 years with no additional contributions, that 20,000 grows to approximately $53,000, just sitting there compounding. After 20 years, that same 20,000 becomes approximately $140,000. You didn't add a single penny more. After 30 years, it reaches approximately $370,000 from a single $20,000 investment. That's compound interest. Now imagine you keep adding $500 a month on top of that initial 20K. The numbers become truly life-changing. 20K plus $500 monthly at 10% for 10 years equals approximately $155,000 total. Real math. At 20 years, that combination grows to approximately $520,000, $500,000 from consistent small contributions. At 30 years, you're looking at approximately $1.5 million, millionaire status from $500 a month and patience. This isn't fantasy. This is what the S&P 500 has historically delivered. Vanguard and Fidelity data confirm these average returns. The S&P 500 has returned an average of 10.26% annually since 1957. That's nearly 70 years of data. Even including every recession, every crash, every crisis, the market has always recovered and reached new highs eventually. The 2008 financial crisis saw a 57% drop, but by 2013, the market had fully recovered and surpassed previous highs. People who stayed invested through 2008 and kept buying saw their portfolios double and triple within the following decade. People who panicked sold locked in their losses permanently. They turned a temporary dip into a permanent financial setback. Your behavior matters more than your strategy. Fidelity found that their best performing accounts belonged to people who forgot they had accounts. Set it, forget it. Let time and compound interest do the heavy lifting for you. That's the entire system in 6 words. Now let's talk about tax optimization. The IRS gives you legal tools to keep more of your money. Use every single one. Roth IRA contributions are after tax, but all growth and withdrawals in retirement are completely tax-free. That's a massive advantage over decades. Traditional 401k contributions reduce your taxable income today. If your employer matches, that's literally free money. Never leave it on the table. The average employer match is about 4.6%. On a $60,000 salary, that's $2,760 free every single year. HSA accounts are triple tax advantaged. Tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. The ultimate stealth account. The IRS allows $4,150 in HSA contributions for individuals in 2026. Max it out if you can. Tax loss harvesting lets you sell losing investments to offset gains. This can save you thousands in taxes every single year legally. Long-term capital gains tax rates are 0, 15, or 20% depending on income. Hold investments over 1 year to qualify for lower rates. If you're in the 12% tax bracket or below, your long-term capital gains rate is literally 0%. You pay nothing on gains. SSA data shows the average Social Security benefit is about $1,900 a month. That's not enough to retire on comfortably by any measure. You need your own wealth engine. Social Security is a supplement, not a retirement plan. Build your own portfolio starting right now. The 4% rule says you can withdraw 4% of your portfolio annually in retirement without running out of money for 30 years. To generate $40,000 a year in retirement income, you need a $1 million portfolio. That's the 4% rule in action. 1 million sounds impossible until you see the math. 500 a month at 10% for 30 years gets you there. That's the power. Let me give you the exact allocation I'd use if I were starting from 20,000 today with a 30-year time horizon ahead. 60% VTI for total U.S. market exposure. This is your core holding. Broad diversification across over 4,000 American companies. 20% VXUS for international diversification. Global exposure protects you if the U.S. market underperforms for an extended period of time. 10% SCHD for dividend income. Reinvested dividends accelerate compounding and provide a psychological boost, seeing regular cash flow coming in. 10% BND for bond stability. This cushions your portfolio during downturns and reduces overall volatility so you sleep well at night. Total expense ratio for this entire portfolio is under 0.05%. You keep 99.95% of your returns. Compare that to the average actively managed fund charging 1% or more. Over 30 years, that fee difference costs you hundreds of thousands. A 1% fee on $1 million portfolio is $10,000 a year. Every year, for decades. That's a car payment going to fees. Low fees are not boring. Low fees are how you keep your money working for you instead of working for a fund manager. Rebalance your portfolio once a year. Sell what's grown too large and buy what's underweight. This maintains your target allocation and manages risk. Don't check your portfolio daily. Vanguard research shows that investors who check less frequently earn higher returns because they avoid emotional trading decisions. The biggest risk isn't a market downturn. The biggest risk is you panicking and selling at the bottom. Control your emotions and you win. Write down your investment plan. Put it somewhere visible. When the market drops, read it. Stick to the plan. That's your edge. Wealth isn't built in a day. It's built in a decade, 2 decades, 3 decades. The people who win are the ones who don't quit. You don't need to be a genius. You don't need to pick stocks.